Hi there, this is Helen Tarrant again from another here with our whole team. Wow, it's massive.
Welcome everyone to another episode of Commercial Property Roadshow or the podcast, depending on which way you decided to join us and be with us today to talk about depreciation. So, of course, it's always one of those topics that people think, yes, no, should I do depreciation? Should I not do depreciation? Is it really worthwhile? So therefore, I've got Mike Mortlock here from MCG Quantity Surveyors. So you guys do depreciation. And I believe even though you're based in Newcastle, you cover all around Australia, right?
Yeah, I mean, I happen to live in Newcastle, live in Lake Macquarie, but most of our business is really not actually in Newcastle, much more in Sydney and even Melbourne and Brisbane as well. But yeah, we cover the vast majority of the country.
Right. Okay. So tell us a little bit about what you do and what exactly is depreciation. Yeah. And we've got a couple of case studies, which we just always like to, throw at people so that it becomes more real. Yeah.
Yeah. And that's a great approach, right? To be able to sort of send something through to me that's a live deal. Or something that's transpired, and we can say, look, this is how it all kind of works. So, quantity surveyors are construction cost estimating specialists. So that's really our area of expertise. That's the degree that we do. Quantity surveyors do a whole host of different things, from contracts administration to feasibility estimates and all those sorts of things. But the focus of today is tax depreciation, and that's my personal specialty. So we work with any owner of an income-producing property. So that can be residential property, commercial, industrial, retail, agricultural, all those sorts of things. So depreciation is essentially an allowance for the wear and tear of the property. So with the items in the property, we estimate their value and they decline in value over time. Now, that decline in value percentage comes to us really from the tax office. So the value of a depreciation schedule is just being able to see what the decline in value of those assets are each year. And in that end financial year report, it'll show you the figure that you can claim off that taxable income. So it's really an important thing for cash flow as a commercial property investor.
Yeah, so what that means to an investor is that if you were, say, you had $20,000 in positive cash flow that's coming through, and ordinarily you'll be paying tax on the $20,000, the depreciation, what it does, it helps you to write off part of that positive cash flow. I mean, in resi, it goes the other way, just it helps you bring you back to neutral, but in commercial, it helps you to do a bit of tax minimization. So this is where it comes in. And this is why people want to have that depreciation, especially if you're in the higher tax bracket. And even if you're using it through trust or company, you end up still paying towards a higher tax bracket. Depreciation can mean a lot more. And for some of our investors who are doctors or professionals and they're earning that higher income, they actually tell me that it's having depreciation is adding an extra half or sometimes towards 1% of extra yield on their bottom line in terms of the return on the property.
Yeah, exactly. And I think if you think about maybe using the residential example of deductible components of property investing, number one is really the interest-only component of the loan. And then I think second, over and above repairs and maintenance, over and above property manager expenses is often the depreciation. So it's a really important thing, and a lot of people overlook that. And the result of that is just you're really leaving money on the table.
Absolutely. So we can't leave money on the table, so it's really important. And so with that, we'd like to show you a couple of examples of the property. Now, the first property we'd show you is the tenanted property in Townsville. Now, this property is an off-market deal, so it's just gone to contract. And what we're seeing is that it's not your traditional kind of building. It's sort of in the middle. It's an older style, but it's got a beauty therapy in there. And it's got like a Salvo's kind of tenant down the bottom. So it's split into two. It's quite a bit of a big block. We don't actually have an IM, so we don't have photos, but this is the best we could do out of Google Maps.
No, and I mean that makes it a little bit more difficult. We're sort of estimating what's in there, but there's enough here to tell a pretty detailed story. I mean, it's a beautiful old building. The positive to that is, it's aesthetically quite pleasing. The negative to that is that the original structure is going to be built prior to the cutoff date for depreciation claims on the original building structure. With commercial property, it depends on the type, but for the majority of them, it's the 20th of July 1982. So that means that there'll be no claim on that original building structure. But if you have a look at it, from what I understand, there's 5 tenancies, top floor office space, about 300 square meters. There's not a lot of photos for us available, but on the bottom floor, you can already see there's some retail space, there's a foyer, there's a 2-car garage and a common bathroom that I've seen. The bottom floor was refurbished, according to our details, around about 2014. So there's structural components of the renovation would actually qualify for depreciation. So the original building structure won't, but the structural components as part of that renovation would. So new shop front, works to the foyer, lifts, bathroom.
This is one of the tenants, and I'm just trying to see if we get some photos of the space.
It would be nice.
Because sometimes they have galleries of the space. So let's have a look at their day spa. They normally have some photos, but maybe it's just generic photos rather than anything else.
Yeah, they look like there's a bit of stock stuff in there. But I mean, you can imagine by that type of tenant, there has to be a reasonable standard of finish, right? You don't want to go into a massage place and can't find the place that's a little bit run down. Okay, so they've got to do it to a reasonable standard. So all of those works are part of it. The bathroom's going to be updated, electrical painting, upgrades to ceiling tiles and things like that. Yeah. On top of that, the roof and the guttering were replaced around about 2 years ago, and we can see that from satellite imagery. So the first financial year worth of deductions based on the renovations would be around that sort of $5,000 to $7,500 range. The plant and equipment items are going to be those, the lifts, the lighting systems, the air conditioning, the hot water, bathroom accessories, signage, all of those things. So there's probably 120 to 150K worth of those in there, which is about 15 to 20K worth of deductions in the first full financial year. So our total estimate for the deductions in this property, and consider this, it's too old for the original structure. So sometimes people would say there's actually no value in a depreciation schedule. We'd actually be thinking somewhere in the $20,000 to $28,000 worth of deductions in the first full financial year alone. So a clear case study where there is some significant depreciation deductions available to an older property.
Well, that's amazing. And of course, like this one doesn't have an awning over the top of the balcony. One of the things tenants talking about is getting that awning done, or getting the vendor to do the awning. Now, that's usually something that then adds on to that depreciation schedule, and they can depreciate that, right?
Yeah. So whatever they spend on the awning, assuming that it's not an automated awning, it is just a fixed structure, you're getting 2.5% of the value or the money spent each financial year for 40 years. So unfortunately, being a structural addition, it doesn't have a short effective life like other things like vinyl floors and those sorts of things. But still, you are able to claim all of that money back over 40 years in deductions anyway.
All right, that sounds really, really good. So, I mean, like that's a perfect example, because a lot of people do think that, they want to buy newer buildings over an older building because they prefer to have more deductions. So, which brings us to this point of showing you a property that is brand new, literally has had no one occupy it. So this is just the information memorandum of the actual complex itself. So it's newly built, probably only 12, 18 months. No one's occupied the property. The property was bought vacant. We're looking at getting a tenant in for the client, and then once they're in, they'll look at either selling it or refinancing against it. So, tilt panels, car parks, you're very, just very standard, in some way standard.
Yeah, I mean it's quite beautiful for the type of construction that it is. I think maybe you've got to be an unusual person to see beautiful in an industrial warehouse office space, but they can be quite ugly. But yeah, this is a nice looking place.
No, it definitely. I think it's got the nice colours and stuff, or what that makes it really nice. So, what would you think when you look at something like that? Because obviously people prefer to go, oh well, it's all new, nothing to worry about. Or do we get a higher depreciation from something like this?
The thing about these industrial warehouses with office space is the construction cost per square meter is quite low. There's not a lot of sophistication from a construction standpoint. It's often just the tilt up concrete slab, or often there'll be portal frame warehouses. So to build this per square meter is going to be a fraction of what it would cost per square meter to, say, renovate the downstairs of the previous property. So we're talking about 126 square meter warehouse. I think it was 100 square meter first floor office with a little reception showroom as well. So we've got the capital works deduction. So the building structure will qualify with it being brand new. They also have a share of the common area. So driveways, that would be under a strata plan. So they'd own a percentage of that. The fencing, all those sorts of things. I don't know if there's an automatic gate sort of to get into the complex, but that would be included. First financial year deductions, we'll be kind of thinking for between sort of 7.5 to 9 on the structure. And then with plant and equipment items, actually I can see here in my notes, I looked at this a little while ago, there's 2 actual electric gate motors and controls that belong to the strata. Yep. You've got the car park flood lighting. There's a common CCTV system, switchboard signage. And then specific to the property, it's got those high bay automatic roller door motors, obviously the lighting, fire extinguishers, hot water systems, all the things that you would normally attribute to an office. So air conditioning, exhaust fans, carpet, door closers, and those sorts of things. So we would see, we would across the both of it, so the structure and the plant and equipment items, we'd be normally thinking around that sort of $13,000 to $16,000 mark in the first full financial year worth of deduction. So here's a case in point where still excellent depreciation deductions, but not actually as high as the previous one, which is an older style property where the original bones aren't qualifying.
Yeah, well, that's very interesting because this one, obviously being a smaller property, was that around that 850 mark when we bought it. So still very substantial. But the other one, older, significantly older. But like you said, it's we're getting about what, 28,000 for something like that.
Yes.
Yes. So definitely very different. So when should people be getting a depreciation report, and how should they be approaching something like that? Like, what kind of information do you need? Like, they'd have to tell you how many toilets are in the building?
Well, we conduct an inspection on the property, so they don't need to do that at all. From a feasibility point of view, we would just kind of want to get an online listing. If it's off-market, some basic information about the property, and even off-market transactions, there tends to be a history of the building. We can often see some things, or if you're inspecting the property or a consultant on your behalf is inspecting it, they can send through photos to us. So we'll make sure that the report is worthwhile for them as a first port of call, but we always recommend to do it straight away, right? Because things change over time. Things are removed from the building. Things are added to the building. You can capture the added things, but the removed things are harder because they might have existed as part of the purchase. So we need to estimate their value as part of your total purchase price. And you can only normally backclaim a couple of years worth of deductions. So if you do leave it too late, there will be missed deductions. And, we collect a bit of data on that, and there are significantly missed deductions by people delaying it too long. So we always say, do it straight away.
Actually, that's a really interesting point, because I'm doing that Cairns property where the old NAB building where I've just got the most updated quote in terms of gutting that building. So, and just gutting all of the stuff that's in there, all the NAB fit out.
Yep.
If your advice of that is before I go and gut it, would be to actually get the depreciation report.
Yes. In some cases, we would want to do an inspection before and after, but at the very least, let's just say that things are getting ripped out this afternoon. You would ask the builders to please take a few photos around before you actually do that for us. I mean, in the past, we've had owners, chasing skip bins down the street just to catalogue what was in there, because that's what's really different about commercial property as distinct from residential. On the 9th of May 2017, they changed the rules for depreciation on plant and equipment items. So things like carpets, blinds, hot water systems, which are common to commercial. There's actually a lot bigger list of plant and equipment items for commercial. The rules said that after that date, 9th of May 2017, for resi, you can only claim plant and equipment if you're either buying new or you're installing new. Those rules don't apply to commercial. So we can actually look at a property that's 10 years old and estimate the residual value of the plant and equipment items, and you're actually able to claim those things. And what a lot of investors used to do is look at those residual values and then renovate the property, throw those things away, and you can claim an immediate deduction on those items that are going in the bin. So whatever's left over, you can chuck that away. There's a few nuances. You would need to talk to your accountant because there are things like you need to satisfy the fact to the ATO that you intended to rent the property as is to begin with. But there are ways that can be sort of substantiated. So that's why I think it's important to get those reports up front. And when you are doing the improvements or the fit out, chances are you will have all of the cost information available there. If you don't have the breakdown, that's where we can add value in an inspection afterwards as well. So if you engage someone to do, let's say, a $300,000 fit out, we can't claim more than the total $300,000. But if we can go and itemize those plant and equipment items that have, say, an 8 or 10 year effective life instead of a 40-year effective life, we're bringing those deductions forward. And $1 today is always worth more than $1 tomorrow.
Absolutely. I think that's what people don't realise. So, I mean, that's a great tip because we know that some of our clients at the moment are doing vacant uplift properties, so they're refurbishing, so including myself. So I'll be sending that property to you, so you guys can definitely do that report. But how do people get in touch with you? How do they want to find out more? What's the best way?
Yeah, they can go to our website. It's MCGQS, so it's MCG like the cricket ground, and then QS for quantity surveyors.com.au. So we've got quite a few resources there. I'm obviously on LinkedIn, Mike Mortlock, Facebook, Instagram, not on TikTok. Maybe one day. I don't think I'm cool enough.
Well, when you're doing inspections, you could be doing your TikTok thing.
Yeah, stay tuned.
Speed TikTok.
Stay tuned. I don't think it's going to go viral unless someone sort of runs over me or something in the process.
Oh, well, you might be counting toilet seats. Some one of these things. But that's great, guys. Look, we'll be putting Mike's details in the description. So they'll be in the podcast description and also in the YouTube description. So you can click on the link to his website. You can also find out there'll be a link to his LinkedIn, probably. That's, I think, the best way, or Facebook page. We'll find a few of your ways of contacting you and put it in there, plus his email address, so that if you need to contact him directly, you've got that. And of course, our email address and our details, so that you know that if you can't contact him for whatever reason, send us an email. We'll do a referral. We'll refer on. But feel free to ask any questions, post any comments. And the most important thing is that let's keep this going. Anyone you think about who needs depreciation, send them Mike's way, because Mike actually geeks out on this stuff, and that's really great when he does. So it's always good to have a specialist. So thank you, Mike, for being with us. Thank you for sharing tips. And we look forward to seeing you at our next video, where we'll talk a different topic about depreciation.
Keep them rolling. Love the case studies. Thanks for having me, Helen. Appreciate it.
No worries. Thank you. Bye.